They viewed the spike as transitory. They were wrong. Is the drop, the disinflation itself, transitory?
The key about that issue is that it's important to think about why is it, for example, supercore is still so elevated. Why is it not really coming down, in particular not on the PCE side? It's because the service sector is still doing quite well. People are still flying on airplanes, still eating at restaurants, still staying at hotels, still going to sporting events, concerts. That's why you see supercore inflation, meaning consumer services inflation, do quite well. So on a number of fronts, it is still for the Fed the case that they might still have to step a little bit harder on the brakes. I don't think we'll get more Fed hikes, but they still need to keep rates elevated to make sure that the service sector starts to slow down, because we haven't really seen that quite yet. And that's at the core of this discussion, namely, do we need to see goods only come down because the goods sector is back at pre-pandemic levels when it comes to inflation? But if we also need the service sector outside of housing to come down, then we do need restrictive monetary policy for quite an extended period ahead of us.
Well, Torsten, that's the question, isn't it? Are we sufficiently restrictive? You put out a deck. I've been talking about it the last couple of days over the weekend. Just fantastic charts. Charts after charts suggesting that we're starting to bite. Fed policy is starting to bite, maybe perhaps more slowly than we thought it would be, but it is biting. Are you convinced by that?
Absolutely. And the key issue here is it bites every single day. At the moment, every single day, there are companies who cannot get a new loan because interest rates are too high. There are companies who cannot roll over an existing loan. Likewise, on the consumer side, delinquency rates are going up on credit cards. Delinquency rates are going up on auto loans. Every day, because of the cost of capital being elevated, because the Fed has been hiking rates, there we are seeing both on the consumer side and on the firm side that it's beginning to bite, as you're saying, harder and harder. And if you think about it from a Fed perspective, this is the whole idea from the Fed. That's the reason why they're raising rates. They want us to spend less on our credit cards, to buy fewer cars, to hire fewer people in companies, to build fewer factories. So in some sense, this is exactly what the textbook would have predicted, that the economic data is exactly beginning to see the implications of Fed hikes beginning to show up.